Okay, so let's get started. So welcome back, everybody. For those of you who are new, house rules for the seminar, or we treat this just like a normal seminar. So if you have a question, just go ahead and unmute yourself and break in like you would if we were all sitting together in a room. And then we'll have more time at the end of the seminar. We'll keep the stream open and we can ask more questions and make more comments. So, okay, without further ado, Swati, you have an hour.
Great. Thanks so much, Kim. And really nice to see familiar faces again. So what I'm going to talk about today is wage stagnation and the Brexit exchange rate depreciation. There are enough Europeans in the audience. I know that you'll know what Brexit means, and I'll talk about what specifically we'll talk about here. So just to remind you, even though I know you're trying to possibly forget, but there is this long-standing trend towards global disintegration that's going on, typified, of course, by Brexit, Trump, now possibly even COVID add to the mix. And what this is really what this paper is trying to do is to look at those moments in where deglobalization has set in to see what the impacts on workers is. So very, very quickly, what I'm going to show you is that, at least in the UK, what happened was that one of the key things from the Brexit referendum was that the unexpected result that it's a leave vote ended up creating the biggest depreciation, overnight fall in any of the major currencies in the world that happened, and it happened within moments. And that's what we're going to use to be able to think about how that impacted workers. So just to give you a sense of why this is a lot of the literature in exchange rate depreciations has thought about large depreciations. This is basically the biggest one. And since it's happening in one of the four major currencies, what you end up also seeing is not just that the sterling depreciated, but there was a lot of differences in terms of what happened to different currencies. We're going to use that variation across currencies when the sterling depreciated to be able to think about how different industries, which have different exposures in terms of economic linkages to different countries, how they were differentially affected. And then we're going to try and trace out what the wage and labor market impacts were. So this is, in one slide, what I'm going to try to convince you happened, which is that, what is this picture showing you? So on the x-axis is the quarterly time series from 2012 Q3 to 2018 Q2. This line, vertical line, is basically when the Brexit referendum happened, which is 2016, June 23. And this is the wage rate across two different types of sectors. And which sectors are we talking about? The black line is going to show you who the below median exposure industries are. These are ones that don't import very much in terms of intermediate imports from countries against whose the sterling really dipped. And then the gray line is the above median, the more exposed sectors. And originally they were moving along together. These are the average that you can see around here, which is the average growth rates in these two sectors. And then afterwards, what you end up seeing is basically this fanning out. And these above median exposure industries ended up seeing a much bigger dip in real wage growth compared to the less exposed sectors. And just to put those numbers in terms of what was happening, before they were growing at about 1%, both sectors. And by the end of it, what you end up seeing after this period is that the average growth rate for the below median industries turns out to be minus 0.4, while the above are still growing, but at a more subdued rate of about 0.6%. So that's what I'm going to try and show you, that this in fact was driven by the exchange rate depreciation that happened in that period. So I'm going to start with what exactly transpired on that evening to show you what the exchange rate depreciation is, which is the shock we're going to use. And then from there, I'm going to give you a little bit more in terms of what the setup would be, which is the kind of elasticity we're trying to identify, and then show you the key results and open up to bigger discussion about how to interpret these numbers. So do please feel free to interrupt me. I'm just going to go through the related work slide in very, very broad strokes, because as you can imagine, this is a huge literature. What we're going to do is look at the exchange rate, wages, and employment link, and along with what is happening, how the exchange rate is manifesting itself in trade. And then this is, of course, related to a lot of the work that's happened both in the exchange rate literature and the trade literature about what labor market impacts are. What is rare in this literature still is putting all three of those things together to be able to use the exchange rate variation. And largely that's been rare because of sort of the difficulty of getting sort of in more recent times of being able to get some kind of significant variation, which will then translate itself into labor market impacts. Another reason that's been sort of more muted of late is because much of the sort of data that we look at, we're really sort of typically thinking about manufacturing workers. That's where the big shocks have happened. While, of course, we know that in many developed countries, that's really not part of the full labor market story anymore, because many people are employed in services industries. And that's what sort of is going to be different about the paper too, that we're going to be able to look at the entire sort of private sector economy of the UK. So this is broadly what happened that evening, which is 6 p.m. is where we're starting. We're both the sort of, I'm showing you the pound to dollar exchange rate and the pound to euro exchange rate. So the gray line here is the US dollar, the black line is the euro. And they were basically rising. There was at about 10 p.m. There was when polls closed, and about 10:15 p.m. is when the first news sort of comes out, the first exit polls. There was a YouGov poll which said that it looks like it's going to be 52% Remain. So the pound sort of goes up, and then the new result, the actual results of the referendum start coming around here, which is when Gibraltar is the first place in the UK to declare the vote, and I think everybody except one person in the island voted to Remain. And then this is really what happens when the actual results start to come in. So what is this particular timeline that I'm showing you here? This is when the first sort of important leave vote came out, which is Sunderland announcing that 60% of the people in the Tyne and Wear area had voted to leave the European Union. So that's when everything changed in terms of the Brexit vote. Whatever, in the sense of the bookmakers changed their odds, gold prices went up, US Treasury bond prices went up, all of this sort of started to happen. And what you can see here, sort of the bloodbath sort of continues till a bit later, and you see this sort of really big drop compared to the US dollar, a little bit of a muted drop compared to the euro. So, and just to sort of give you a sense of magnitudes, this already is when the UK broke the exchange rate mechanism, which is Black Wednesday. This is a shock we're looking at, which is sort of much bigger than that, sort of bigger than the financial crisis shock that happened with the pound. So if you want to get more of a sense of sort of what was going on, what is the cross-country variation here, you see a much bigger drop compared to sort of what you might think would be less connected countries to the UK. So Japan, US being the primary ones here, that the pound really dips compared to the Japanese yen and the US dollar. You start to move around here and you start to see more European countries. You can see Polish zloty, of course. So those are the ones which really didn't quite move as much as the trades that happened here.
So just, Swati, can we think about that think about the euro-dollar exchange rate? I've just pulled it up on my computer, that there's also an impact of Brexit on the euro-dollar exchange rate, and that's this gap.
Yeah, so that is precisely this gap, which is that when the pound dipped, it dipped lots more here compared to this. So yes, the US dollar and the euro sort of transactions are also, exchange rate is also moving. The sterling did continue to stay much lower even till much afterwards. So this was fairly persistent. And even in terms of the sort of broad patterns, they'll continue to sort of stay that way. We're only going to use this particular 24-hour period for the depreciation. Is that the question? Or are you thinking more deeply about what this might mean about the exposure of different countries?
Well, just, we've got, exchange rates, there's a triangle equality. So, if the sterling is moving in a certain way against the dollar and a certain way against the euro, that tells you what's going on with the euro dollar. And when I try to think about what might be determining that, it's okay, Brexit has an impact on the Eurozone, which is driving the US dollar euro exchange rate to have a certain movement. I want to bear that in mind when I think about this differential. That it sort of means that the Eurozone is more exposed to Brexit in a certain way, maybe, than the US.
So I'm going to show you some, when we get to the discussion, I can show you some more on this in terms of how you might think about that exposure through, the usual things we'll think of, like trade, migration, FDI, so on and so forth. In as much as, for the stuff that I'm going to show you today, in as much as you believe that the right-hand side is really sort of a shock, an unexpected shock, I'm going to show you the labor market impacts of that, some of the trade impacts too. I'm going to try and sort of then later come to saying that, okay, what do you think went into this news? Was it the Brexit news, or was it just the financial trades that are changing somehow? Or did it have something to do with the economic linkages? And roughly the answer is, it looks like it is correlated with trade barriers to some degree between the UK and the European Union, but not very much else. There isn't, like, I can't really sort of tell you it's precisely FDI or precisely migration. It's kind of a combination of these things. So this is, I think, maybe a little bit what you were asking, which is that here's the exchange rate, sort of, if we think of it in very, very simple terms, sort of the way the financial news literature thinks about it, then they would say that the exchange rate at the currency level is determined by some, here's the state of the world, here's the public's perception of the state of the world, and the change in the exchange rate that's happened in that very, very particular time window of that 24-hour period when we're seeing the exchange rate dip, that's what we're going to say is the Brexit shock, basically. And this is some sort of, the Brexit shock is causing all of these different kinds of currency variations that are happening.
So can I ask a question about this too? About, the exchange rate is kind of like an asset and it's forward looking, and these guys maybe we're building in policy responses, whether it's from the UK or from the EU. And so how much does this, even though it's like on impact that night, how much is that actually reflecting all the other stuff that's going to expectations about stuff that's going to happen out there in the future? You understand what I'm saying?
Yeah. So in as much as, I'm going to give you sort of two answers. One is, to some degree, it doesn't really matter, in the sense that as long as it's something which you think move trade prices, which is how we're going to trace out the effect of these things, then whether it's coming from trade barriers or from exchange rates per se, I don't really sort of care as much in terms of the sort of wage price elasticity that I'm looking for. But the broader point that I sort of take from you is that this is really about sort of more broadly, that this is building in the information about the trade policies and the expectations of the trade policies that are going into the determining the exchange rate. And that's perfectly fine. I mean, and I would say that, yes, you should be totally fine with making that interpretation that this is the Brexit news about the trade exposure.
But it's not just the trade exposure. It's also like the Bank of England started, I think, loosening, very quickly afterwards that, and then, the European Central Bank probably were thinking, so all this stuff is moving around. So it's kind of like, it's just not about, I mean, I take your point. It's kind of just, but it's like, it's really just about the exchange rate. I got a big move in the exchange rate. Why is it coming about? Is it like per se because of the trade barrier or everything else? I don't know. I mean, but it's really about, I get this sharp move in exchange rate and I can trace out how it's going to happen. But
yeah. So just two things in response to that. That's totally fine. So just for a moment, think of it as this is any exchange rate movement, and I'm going to try and see what the labor market impacts of that are. That's perfectly fine with me. The second sort of component of it that you're saying is that, look, once the exchange rate changed, it's not just the exchange rate that changed at that moment, but after that, it set off these events and about these expectations and so on and so forth. It turns out, actually, we are going to stop very much at the point when the Bank of England, before the Bank of England announcement happens, before really any major market opens up, and which is about 4:30 p.m. is 7 a.m. the next morning is when the Bank of England's going to announce, and we're basically going to stop before that. So it's just that precise window, which hopefully is capturing the Brexit news. So in that sense, I mean, it's only going to be that short window. So every time I look at the right-hand side variable, I'm never going to use the full exchange rate series. It's just a matter of that 24-hour depreciation, which we're going to use. So this is not sort of trying to be a theoretical framework which tells you something new about the world. This is just to sort of put those things together so that we can get an estimating equation and then take it from there to saying, eventually, how do we interpret this number? What does it mean? Which kind of elasticity is it? So I'm going to make these basically three assumptions, really, or rather three sort of equations that I'm going to give you. One is about what the exchange rate shock is. So this is that currency interacted with the Brexit news coming in. This is the part about what the labor market looks like. So we're going to just assume that firm production basically combines labor, intermediates, which could be domestic or imported. And just by simple sort of profit maximization, and then Hoteling's lemma is going to tell you that the labor demand by a particular industry, or so that's the output producing industry, is going to depend on the wages that that industry pays, the price of intermediate imports that that industry buys, the domestic intermediates, the export prices that the industry faces, which could depend on all these different destinations that you sell to. And you could be buying from all of these different source countries and intermediate inputs. And this, of course, is the domestic price. So then the third part of it is going to be that wages are set by market clearing of industry-specific labor. This is what's going to let me say that, okay, if there's some level of friction at the industry level, then there's a sensible thing to, it's a sensible thing to look at the industry level variation and be able to see whether some industries were more exposed or not, and what happened to workers in those industries versus other industries. So these are the three components going in, and that already would give us, just very simply, that the percentage change in wages is going to depend on some sort of intercept here. This is the key elasticity that we would typically be interested in, which is when intermediate import prices rise by 1%, what happens to wages? How much do wages change? And the second part of it would come from the export side as well, that you're exposed to the exchange rate, not just through what you buy, but also through where you sell. And that's going to tell you if my export prices, in fact, I basically ended up seeing higher sterling prices or something, or higher demand for my exports, that's going to show up in this theta XW. So depending on how you sort of parameterize the model, if you wanted to write down a full-fledged model, this theta MW is basically what we're going to be able to identify. And what I'm going to sort of show you is that this is the number that we're going to find turns out to be that if the intermediate import prices went up, the wages actually went down in the country, which was the sort of second slide that I showed you about the two graphs. And this can be interpreted if you write a profit maximization down, this is the Hotelling cross price elasticity. If you write a cost minimization problem down, that's going to be the Allen cross price elasticity. And if you went with the really even more stringent assumption and say it's a zero profit condition that binds on these industries, then this is basically going to be the intermediate import to labor share. And we're going to sort of just go to the data and see what that number would look like. I have some idea of which kind of elasticity we're identifying now, but I don't have sort of new results to show you quite yet on that. Okay, so this is what we're going to do. We're going to look at the change in wages in a particular output industry. I know this is not a very good example, but I'm just going to use it right now because the car industry is easier to think about. So these are what car sector workers, what people employed in the car sector are getting. This is saying what is the car sector buying of different car components from different countries? What's the intermediate import price index of that? This is saying what's the export price index of cars that are sold by the UK. And the second sort of part of it would be how these prices themselves respond to the exchange rate. And that's going to depend on, of course, this number, which is telling you just what the intermediate import price pass-through is from exchange rates to the prices of intermediate imports. So how much does the UK how much does the UK buy of different car components? If it's 20% coming from China, 80% coming from the US, then I'm going to say it's 20% into the Chinese yuan depreciation plus 80% into the US dollar depreciation. So that's how this is going to be constructed, and that's what's written here. It's basically the trade-weighted exchange rate depreciation. And this here, similarly, is the export-weighted exchange rate depreciation. That's the export price index. We're going to enter in both of these here because your export prices can be affected by both what you buy as well as what you sell. In principle, you can put the export price and export exchange rate here, but we're not doing that because it's a bit awkward for the theory, but it doesn't really matter for anything that I'm going to sort of show you in terms of empirical results. So that's what's going to give us the reduced form for the wages, that the wages in the car industry are going to be affected by both what the car industry's exposure in terms of its source countries is, as well as in terms of its destination countries. So just a bit more boring stuff for notation's sake. So what are we really doing?
On notation, just to make sure I'm not getting mixed up. Whenever you say W, you mean a real wage, not the wage in pounds?
Actually, we're going to put nominal wages on the left-hand side, but everything is going to have an quarter time fixed effect on the right-hand side. So in principle, what you're seeing are the real wage effects. The chart I showed you earlier was in fact real wages, not just nominal wages.
Yeah, I saw that, right. But in these expressions, you're sort of, I should think of it more like not everything is measured in pounds.
Yeah.
Okay.
It's going to be in logs. So, I mean,
yeah.
Okay. I'm with you. Yes, nominal wages. And then as long as you think that people in the car industry consume similar sort of basket as people in the financial services industry or the legal services industry, then the quarter time fixed effect, the time fixed effect is essentially netting out the price index moving, the consumer price index moving.
So Swati, I'm sorry to interrupt also, but I'm missing where all the domestic prices went.
So in principle, you could have the domestic prices in here. In as much as the domestic prices are not going to be affected since what you buy from home is sort of denominated still in pounds, it's not going to show up in the exchange rate sort of changes, the changes induced by the exchange rate. But in principle,
sorry, yeah, go ahead. I'll let you finish. Sorry.
No, go ahead. It's fine.
So I guess this is all because you're just thinking about this super narrow window. I'm thinking about changes in demand, changing prices. This is like, I mean, you were exporting a bunch of this stuff and now I'm going to sell it all domestically. That's not going to affect the domestic prices? Or is this something?
That's going to affect the aggregate price index, definitely. That's going to go into my time fixed effect. So which is why it's not showing up here. But if you thought that there was a time period here, that's essentially going in here. Now, if you wanted to get even fancier and try and sort of trace out the second order effects, in principle, that could be done. We haven't done it yet in that sense. So I'm not sort of taking out the feedback effects going further in there.
Okay.
Largely for the reason that the data we're going to use is going to come from a supply use table and from actually observing what firms buy and sell directly. So I haven't really done that, but in principle, we could, I take your point that could be done because this is not capturing then the entire effect. We're going to just identify the micro elasticity. We're not aggregating back.
And then somewhere is something going to get taken care of that some of these firms might not, or some of these people might not be exporting a bunch of stuff, that they just may not have a lot of exposure to this. They do mostly sell domestically. I mean, is that going to be taken care of somewhere?
Yeah, so we have one definite industry like residential care, which just does not export anything.
Yeah.
And we have a separate non-exporter dummy put in everywhere for that. It turns out actually none of the export side kicks in during this time period. We have some ideas about why that might be, and we have more strong results that in fact the intermediate import price increase actually subdues the export shifts. So in principle, that's going on, but we're not even going to see anything really kick in on the export side. So I sort of see what you're asking, but it doesn't turn out to be relevant.
Okay, thank you.
So
Swati, hi, this is Daniel. I have a related question actually. When you talk about services, Kim was asking about exports. I was more thinking about how do you account for the capital movement, international capital movement when you have these big exchange rate swings, in particular for like real estate or financial services. Could be a measure that's thinking about how those things actually impact those industries rather than just direct physical exports and imports?
So, there are two cuts we've done to deal with that. So one is about, let me, I don't know, I can fully answer your question, but I'll tell you two things that we have done that I don't think are confounding the issues that we highlight here. So one is the UK services trade data, it's not just, it's all services trade in the sense of they do record in their intra-firm transactions. They also record in their headquarter services, intellectual property moving across borders, so on and so forth. So in principle, that's in there. Now, there's a bigger issue there about that, okay, you might think that actually some kind of FDI exposure is also driving some of these patterns. We've tried to put in that, just like we're controlling on the right-hand side for these sorts of things like what happened with the exchange rates. We can also try to control for exposure based on FDI, stuff like that. And that doesn't seem, that is kicking in to some degree, but it's not actually confounding the stuff I'm going to show you. So that we've taken care of, but let me know if you think you have other sort of things that I may not be thinking about, which in case I haven't interpreted it correctly.
Okay, yeah, got it. I think that's pretty much I had on mine.
Okay.
Yeah.
But I'll, if we get time, I'll show you some of those results. They're a bit more new, so I don't quite have them as well woven in right now, but I can definitely come back to them. So here's what we're going to do. So this is how we're going to actually estimate the equation. What is the variation that we've got? We basically got the initial trade weighted depreciation for each industry, both on the intermediate import side as well as the export side. From there, we want to trace out, and this is one thing we're going to be able to do. We're going to use price indices to talk about what happened to trade prices, both on the export side as well as on the import side. Mainly, we're looking at prices, unlike a bit of, this is a little bit sort of different from the trade literature for the reason that typically in trade, we would think of trade values as being the left-hand side measure when we think of, say, exchange rates or something on the right-hand side. In terms of services, it's much more intuitive, and generally there's a literature within the US saying that it's much better measured in terms of prices rather than in terms of just pure values and quantities. So that's why prices done, and this is something which is actually available to us. So we're going to use prices on the left-hand side. And you're going to see that in fact prices in this, it turns out that prices do tend to be more sensitive and those will move. The quantities tend to be a bit stickier than that. And then from there, I'm going to try to show you that, okay, can we go from there to saying something about worker outcomes? You could have gone directly from depreciation to worker outcomes as well. But I'm going to show that, in fact, it looks like that the channel through which the depreciation is manifesting itself is through these intermediate imports. So this is going to be what we're going to be interested in, which is when the depreciation happened, a 1% increase in your industry-specific depreciation, how much did that shift your intermediate import prices? You can do the same kind of thing for the export side too. It turns out this particular number in our case is very, very small. It's almost zero, and therefore we're not going to find a first stage for the exports. And the elasticity we're going to be able to identify is going from this beta the intermediate import side to the labor market side. So that's going to be the labor market side, which is saying here's the UK worker J employed in the car industry O in quarter Q at time T. This is that 24-hour depreciation for the car industry in terms of its intermediate imports. That's the post-Brexit dummy. So we're only going to see, that particular time window and what happened before and after the Brexit referendum. And these are, of course, the appreciation and then any other controls you might want to add. We're going to put in some kind of compositional controls, gender, so on and so forth. And you can sort of look at that. So this is the ultimate relation we're going to be interested in, which is the structural wage equation, which is the 1% increase in intermediate import price index. What happens to the wages? So let me talk a little bit about the data. So we've ended up using a really different sort of many different kinds of data sets. So the main industry level data comes from sort of the worker side, comes from the quarterly labor force survey for all those in the US. This is basically the CPS of the UK. In terms of sort of where the trade data comes from, the UK actually does collect trade statistics, which are a bit sort of, I think, really high quality in terms of both services, where they go and they interview firms and ask them about their services trade. And that's how we're going to construct these export trade shares, that how much does a firm sell of a particular, of its output to different destinations, which could be services trade, which is coming from this ITIS, this International Trade and Services Survey. For goods trade, we're more constrained the way sort of most of the literature is in terms of the proportionality assumptions, that we know where stuff is coming from in terms of that particular car, how much are different cars coming from where, but we can't really assign it to particular industry in terms of sort of where precisely are those cars going in every industry.
Swati, I'm kind of losing the thread here, because I thought you were just telling us that it's only the import prices that mattered for the wages. So I was thinking you wouldn't tell us anything more about exports since.
Sorry. No, that's my fault. I should have said that. We've kept it very symmetric. It just turns out to be the case that the export side doesn't move at all.
Okay, so I can, when you're
Sorry about
exporting
that.
exports, I can think, okay, I won't raise any issues there because it doesn't matter anyway, but the imports is kind of the key thing you're finding, right?
Yeah. So it's going to be the intermediate imports. So just think car components coming into the car industry, that side is kicking in. Car exports to the rest of the world is not going to move very much in response to this exchange rate depreciating.
Can you kind of tell your story with this extreme example of like, okay, so you have cars and then you have, and they're importing a lot, and then you have some other industry like, well, I just purchased a mortar and pestle that was made in the UK, and I don't think they imported anything. So what is your story of what would happen to the wages of the guy making mortar and pestles, where he's just using some granite locally, versus the guy making the cars, where suddenly the price of the car components went up, I guess, in pound terms?
So there are two reasons why we're not or rather why that's not what I've been emphasizing till now. So the part that I've been emphasizing is saying, where are the car components coming from, China or the US, given conditional on you doing some getting some car components from abroad. Now your part is that, look, there are certain industries which don't buy anything from abroad. And why not even take that share into account, which is how much is my share of intermediate imports versus, say, labor, which is technically what would also possibly go into this equation. Now, if you thought that shares don't move very much, actually that would be the right formulation. And what you would want to do would be to use the currency depreciation, the cross-country depreciation, together with then also maybe saying that, okay, these can, how much that depreciation matters really depends on how much you import of the different intermediates. So you would have then the second interaction, second variable on the right-hand side, which says, here's the share of how much I buy from abroad into that depreciation that happened. So it turns out actually there isn't that much heterogeneity on that front that we see in the data. So which is why I'm not emphasizing that the share of intermediates versus share of workers is not this part which really kicks in. Most of it is really, most of the action is happening from the within sort of imports, what your currency structure looks, country structure, where you're buying your stuff from looks like. So that's why I'm emphasizing that. But in principle, we could do the other stuff as well.
But an extreme example would then be importing from parts from Poland versus importing parts from the US, where you have a big differential.
So I should mention that quite sort of plainly, which is that a lot of the variation will be driven by which are the industries which are exposed more to the US, which are the industries which are more exposed to the euro. Okay. Where a lot of your trade is with the European countries versus the US. So the most notable one that's going to come into play is financial services, where you see a much bigger decline, a much bigger sort of real wage growth hit. And that's because a lot of their trade, 43% of their trade is with the US.
But so, sorry, Swati, this goes back to my original question on the movement in the euro-dollar exchange rate. So, that movement is a whole lot smaller than this sterling depreciation. It's like, what is it, like a 2% depreciation of the euro against the dollar associated with this Brexit event. So these are going to be much smaller. These variations are going to be sort of across different trading partners, are going to be much smaller than the variation, which is, do I get my inputs from the UK versus do I get my inputs from abroad? So I'm kind of surprised that you say that the sort of the cross sourcing, foreign sourcing is the big thing.
So the key thing is going to be that, yes, the US dollar versus euro matters. We're only using that 24-hour exchange rate variation. And the key point there is that, yes, that could be picking up this exposure. So it is the case that, the euro is declining less and the US dollar is declining. The pound is declining more with that. That is going to show up. If you think that that's really only purely driven by what the initial trade exposure or the trade barrier exposure of these different countries is, then in that sense, what we're picking up is in principle the trade Brexit effect. So that would change the interpretation of what you're thinking of this shock to be. whether you're thinking of it to be really the Brexit shock, that this is how much your economic linkages are going to get damaged, and this is why the pound is depreciating in the first place, that the value of holding a UK asset has declined. So, I mean, so that's up to you. I mean, that's up for interpretation. I'm going to show you some cuts on that, which is what I was mentioning earlier, that how much that exposure can be captured by different kinds of economic linkages. We can kind of do cuts on that and show you where that's kicking. It turns out the key thing that kicks in is really export trade barriers that the UK is going to face. Is really about the only one that kicks in. But again, it's not like that's the entire story. It's not big R squares that we're talking about there. Does that make it maybe a bit better? No. So let me move on then. I'm going to show you there are going to be a lot of pictures and a lot of tables because my co-authors happen to be labor economists. So just a lot of different kinds of charts that you'll see. And here's the first one. What is this showing you? This is just to give you a broad idea of what's happening with the data. So this is the top 4 industries in terms of their exposure to intermediate imports. These are import shares of the top 3 partner countries that we've got on the right-hand side. So this is basically saying if you're thinking of 66, the industry code, then that's security and commodity contracts mean very specific types of financial services that are going in there. And that's mostly trade with the US. So this is the sense in which I was saying that, yes, US versus Euro exposure is going to be where this action is, the top industries. And this is going to be much more dominated by these kind of European-ish, whatever, Euro nation, European nations. And that's going to be all these kinds of products which you're more likely to buy from European countries. So the first chart is basically, this first table is basically showing you what the post to pre-referendum changes are, what happens to intermediate import prices in this time period, what happens to export prices, wages, and training of workers. So training is here measured as how much job-related education and training did you get job-related education and training. This is typically the biggest way in which in your adult life you're going to acquire skills. So what we've done here is cut the different industries, 85 different industries. We've cut them into 5 different categories. These are the really exposed ones to the intermediate import depreciation. These are the less exposed ones. So this is basically financial services. This is paper products. And what we see is that there's a different diff of about 4% higher increase in the intermediate imports that come into financial services as opposed to ones that go into paper products, largely because they're buying from the US while the paper products are buying from the European Union. If you look at export prices, you don't see a very clear pattern in terms of sort of what the differences are. I'm going to show you next the export appreciation as well. So just for 1 second, bear with me. Almost no action in terms of no real cross-industry variation here. If you look at wages, you see much lower wage growth in the financial services industry as opposed to the paper and paper products industry, even though before they were growing at almost the same pace. And if you look at training, this number looks small, but of course it's not small in terms of how many people actually do receive training. That's about 14, 15% in the US as well as the UK, I believe. So this is exports weighted appreciation. So the same stuff I showed you earlier, which is what is happening across different industries in terms of sort of post versus pre-referendum and more exposed industries versus less exposed industries. This is doing the same cut, but now with the export appreciation defining these different categories. And there we see not much action on any of these fronts here. And this is actually going to be the next thing I'm going to show you in terms of sort of just broadly what the pattern looks like. So this is how much of a depreciation shock you got. So this is saying if your paper products, that was the exchange rate depreciation you saw, 6%. If you were financial services, it's about 8%. And this is sloping upwards. That's the intermediate import prices, the change in them. So if you were financial services, you saw much bigger increases in your intermediate imports compared to, say, something like paper products. While if you're looking here, these are the exports, and that's relatively flat. The circles are basically showing you services industries. The triangles are showing you manufacturing industries. And this is the sort of, I'm going to beleaguer this point a little bit. Typically, when we're looking only at manufacturing workers, those are basically the size of the sectors that's being captured by how big the dot is. And the triangles clearly are much fewer and much smaller compared to the really big sort of bubbles that you can see, which are all services industries. And this is the sense in which sort of going to the industry data lets us think a little bit more about the service sector workers, as well as the fact that these imports and exports that they're doing are also typically in services.
Sorry, Swati. This is a clarifying question. I'm just trying, the service is really interesting. I'm trying to clarify when you say intermediate import for the financial services. What is an example? I'm just try to understand, what
no, that's a perfectly fair question. We've asked ourselves that question several times, that what does it even mean to have an intermediate import in financial services? If you actually start looking at firm responses, these would be things like they do legal contracts in the in the US. So they're going to pay for legal services. They're buying financial databases from the US as well. And that's stuff that's going to show up in these records as well. So we've accumulated all of those different things that they could be doing, that different categories of them, but broadly that should be what you should keep in your mind. This is things like databases coming in from the UK, from the US to the UK. So this is. Yeah.
So, but just to maybe this question is a little bit ahead of itself, but then there seems like these are kind of outsourced tasks. So compared with like a standard manufacturing technology, does that call upon to say, maybe the substitutional complementarity patterns will be actually systematically different when we think about these so-called intermediates, across these different industries?
No, you're perfectly right in saying that. I mean, in principle, this could be offshoring. You could call this broad offshoring instead of intermediate imports. I don't quite know how to distinguish that. From our point of view, the way that's being done is to say you're an output making industry. There's stuff that you're inputting. Now, whether that's stuff that you're inputting by offshoring or by services trade, this is typically meant to capture services trade, which means modes other than commercial presence. Is that maybe what you're getting at? Or did I?
Yeah, roughly. We can talk a bit more later, but we can wait for results. Yeah.
So then what I'm showing you next is the change in hourly wages. And this is the same thing, which is, here's paper products, here's financial services, much bigger drop in financial services industry wages compared to what happened in, say, paper products. You can do the same thing with training, a little bit more muted, but basically the same kind of pattern. So instead of showing you pictures, now I'm actually going to start moving to the numbers. And this is the one I want to start with. So
sorry, Swati, sorry to pull you up, but can you go
back
to the picture again?
Sorry. Yeah.
So it's like, how much variation is there in these changes in wages across these different industries? And then you have, we talked a bit about this, but you haven't shown us how these wage changes might be related to the sort of import share compared to the domestic share.
I will
total imports.
I will show you that, which is how much is the share of intermediate imports divided by share of workers in the IO matrix. So I'm going to put that in. Turns out that doesn't really kick in, which is why I'm not emphasizing the heterogeneity there. What does kick in is precisely this sort of first part, which is the currency variation. So in terms of sort of how different are the wage changes, I actually can't remember the top to bottom, but the quintiles should give you some sense of that, which is that here's what we're seeing. It's about a 2% difference, and that's really coming from the growth rates. If you want the broad magnitude, which I shouldn't keep going back and forth on slides, let me just move on. But I will say it in words, which is that earlier, both types of sectors were growing at about 1% per annum. After the referendum happens, the financial services in type industry is going to grow at minus 0.4, and the others are growing at about 0.6%. Those are the broad macro numbers, like above median, below median. I wish I don't remember the precise range across the different industries.
But that's not, that you said that's not related to, let's say, the either the sort of how intensive these sectors are in imported or in their export shares. What share of output is
export? So I'm going to show you those later, but no, they don't turn out to vary in any kind of systematic way with the different shares across how much export exposure do you have, how much import exposure do you have.
Sorry, a quick question related to that.
Mm-hmm.
Are you looking at direct imports only, or are you also taking into account like indirect imports through like domestic purchases? I think this goes
No,
back
yeah,
to
so this was
Kim's
my
point.
answer to Kim, which is no, we're not looking at the indirects.
Okay.
In principle, if we wanted to do an aggregation in terms of what the macro impact of this would be through sort of iterating on the supply use mix,
Yeah.
that we could do. We haven't done it yet. This is just the supply use side, mainly because of the nature of the survey that we're using, which is going and asking firms their services imports and their services exports.
Thank you.
Sorry to keep jumping in on this. What I've had in the back of my head is this paper that I saw by Beata Jaworczyk, where they're, she's looking at these job advertisements, and there it seems that the sort of the export exposure is a big deal in differential responses across sectors. So that's the thing that's kind of bothering me, is that you're saying that doesn't seem to matter for these wage changes.
So okay, let me clarify. So one is that I'm not saying that it doesn't matter in the sense of it won't kick in at all. I will show you one equation where it will kick in, but it won't confound any of the things that I'm showing you. The second thing is, yes, we actually shared our data with Beata, so I'm aware of the paper. That's about vacancies being posted. So that's not representative of the UK economy. This is actually the entire UK economy. So so I would take this as the truth in that sense of what is happening. But of course, if you wanted to get in more micro cuts of like where the variation is, then you would probably want to go to that sort of data. But I'm going to show you some of the stuff which is going to kick in. Okay. So let me move on, which is to say that I'm going to look at, so this is going to show you first what is happening on the first stage, which is that the exchange rates changed on the right-hand side, and the intermediate import prices, how did those react? So with a 1% higher increase in the depreciation that you ended up facing in the financial services industries, you're basically going to see a 0.4% increase in your intermediate import price index. If you look on the export prices, this is what I was saying. In principle, it looks like actually we've got newer results because they've updated some of the price series. And there, this is kicking in, which is that the export prices are going up as a result of the intermediate import depreciation, but you're not seeing any kind of sort of, offsetting effect in terms of that, oh, now suddenly British stuff is cheaper, so people are going to buy a lot more of it. That doesn't seem to be really kicking in. We've done things on the value, quantity, sort of every cut, and it doesn't seem to be kicking in very much at all. And this is the sense in which what Beata might be finding is also consistent, because the export side is not kicking in, probably because of this anticipation of the export barriers, in the future, or export sector exposure. So I want to move to the next part, but before I can do that, what I wanted to show you was that, you have to be careful when you use that data to be able to say that that really is the right pass-through, that 40% is the pass-through roughly. For the reason that if you look at, there's some pre-trends in the data. So this is now showing you the intermediate import price index across the more exposed versus the less exposed industries. So yes, there's a fanning out after the referendum, but there are two periods here which are a bit contaminated. One is when US quantitative easing ends, ECB quantitative easing begins. That ends up changing the euro-dollar exchange rate again. And then there's the second part, which is coming from the fact that, the Brexit referendum didn't happen overnight in some sense. There was an announcement about it, and we can try and check out those announcement periods as well. And the moment you do that is basically where you're going to see that the pass-through, in fact, increases to some degree across these different samples. You can put interactions, you can chuck those contaminated periods out. So either way you cut it, that's basically what we're going to find, is that the pass-through is somewhere between 40% to 60% if you think of those pre-trends being contaminated in certain periods. Then what I'm going to turn to next is first show you just what's happening with workers' wages and training and different kinds of margins of labor adjustment and the exchange rate depreciation that happened. And then I'm going to put those two things together, which is to say, is there a structural relationship we can try and uncover about when there's a 1% increase in intermediate import prices, how does that impact workers domestically? So what this is doing is this is showing you the wages on the full sample of people, and then for these restricted samples where they're contaminated pre-trends, There's no contamination in the pre-trends in terms of the wages at all. They're basically just really moving along very, very similarly. And this is now showing you if there's a 1% increase in the intermediate import weighted depreciation that you faced in the financial services industry, you're going to see a 0.18% reduction in the growth rate that you end up with. And this is, of course, controlling for all these industry dummies and time dummies. So in that sense, that's kind of getting back to what Sam and someone else asked me, that is it nominal wages, is it real wages? So the price index, the consumer price index, is basically getting subsumed here. So in that sense, it's real wages. Okay. So the next part is now putting those two things together, the reduced form of wages on depreciation, reduced form of trade prices on depreciation, to try and get a structural IV result. And what is this saying? This is saying if your intermediate import price index went up by 1% more in the financial services industry, what you would see there would be that the wage growth in that industry dropped by about 0.45%. And this number stays roughly the same. When we put in the export prices, of course, the F-stat here falls because there is really no first stage in the exports. And which is why I was saying that I'm not going to be able to give you any kind of, structural elasticity about what happens when your exports increase to what happens to workers domestically. The part we can give you is this, which is there's a 1% increase in intermediate import prices, what happens to workers? And I'm going to later show you what this means in terms of the microelasticity that's being estimated. Okay. So you can do the same kind of thing for training, and broadly the same kind of result, which is that training dropped as well. So it's not just that firms were reacting in terms of how much they were paying workers, but also in terms of sort of the skill accumulation that's happening on a day-to-day basis. And this is now saying, okay, you don't need to just look at wages and training. You can look at all sorts of different margins of adjustment on the labor market side. And this is wages of all workers, not just full-time hourly workers who we had before, but everybody in the economy. And this is even more sort of responsive to the intermediate import prices. If you look at overtime margin, that's one thing that kicks in, which isn't very different from what happened in the US too, when people have documented. The Camper-Goldberg papers typically do also find that manufacturing workers see a reduction in their overtime pay when there's an exchange rate movement. In terms of sort of, is the way we set up the problem a sensible way of thinking? And from here, what you can see is it does seem to be a sensible way of thinking, because there seems to be some friction at the industry level that workers in a particular industry are taking a hit, and there isn't some kind of big inflow and outflow or employment growth happening. It's not as though the employment margin is really adjusting. It's actually the wage and the training, overtime hours. These are the margins that seem to be adjusting to the depreciation. So I'm going to do a couple of now heterogeneity cuts, and then want to just compare what we have with the offshoring literature more generally, and then say what does the sort of microelasticity mean. So this is now breaking the workers into graduates and non-graduates. And this is saying that the graduates basically were the ones who saw much bigger reductions. And in that sense, they're the ones who, when there's an increase in intermediate import prices, yes, the person employed in financial services typically will be a graduate, and they're the ones who are really sort of suffering compared to, say, less skilled workers. The next part is now the offshoring study. So we can try and compare the numbers that we find with what most other people have done. And the closest we could get to really sort of map what we're doing with more recent work is the Hummels et al. Paper with the Danish matched employer-employee data. Now, that's of course only in manufacturing, but it's still instructive to see what the numbers look like for them versus us. We find bigger elasticities, particularly for the graduates, and that's not very surprising because, one, this is the entire economy. Two, this is the UK, massively sort of engaged in all sorts of services trade, as well as sort of trade more generally. And the non-graduates in our case don't seem to have very big effects at all. Theirs are negative, but of course that's the China shock. In our case, this is a very different kind of shock, mostly driven by developed country trade, not really sort of what happens to China or India. And graduate, non-graduate numbers though look fairly similar to what they find as well. So the next part what I'm going to show you is to say that, okay, if you were thinking of some kind of, say, cost minimization type framework, then what you're really identifying, the number that I showed you earlier, which goes somewhere between 0.3, if you want to look at the entire range across all of the different robustness checks that we can do, this is roughly the range that we find, that a 1% increase in intermediate import prices reduces wages by about 0.25% to 0.45%. So that's the number we can see. And from there, we can try and back out by now sort of, really sort of specifying what these different shares are across workers and intermediate imports and so on and so forth. If you really parameterize this properly with the data, then what you would find would be that the Allen-Ozawa elasticity of substitution, the kind of deep parameter of elasticity of substitution between workers and intermediate imports, is going to be always negative. And negative here means that workers and intermediate imports are actually complementary in this case. Now, of course, that doesn't mean that they're always complementary. This is the UK. This is, we've got the skilled workers in here as well. So let me pause here in terms of I'm going to talk very, very quickly through what other things could be happening. Some of those questions have already come, and then depending on what time allows, I can sort of stop there and we can move it over to the questions and so on. So if Kim, that's okay. Yeah. Okay, so some of these questions came up earlier, and Dorian, I'm going to come back to the one that you were asking first, because I think that's that came up a couple of times. So one is, this is the slide for Dorian. So one is, okay, what's the currency share picking? What's the currency picking up? The depreciation itself turns out doesn't really seem to be very correlated with UK's trade shares, FDI shares, migration shares. Does turn out to be somewhat correlated with the trade barriers that would kick in if the UK were to have a really soft Brexit or a hard Brexit. And I'm going to show you that if I get time. In terms of what happens to if you put in the shares in total intermediates, or say the share of intermediate imports versus labor, those do kick in to some degree, but most of the estimates that we are showing you don't really move. If you put in this, which is the heterogeneity, that it happens to be the case that the car industry buys a lot from abroad, while say, I can't come up with a good example, okay? The residential care doesn't buy anything from abroad. So then this is the ratio of intermediate costs to labor costs for the car industry versus the residential services industry. And that turns out to actually be statistically insignificant in our case. And it doesn't move the estimate very much at all, basically 0.001%. In terms of how we think about trade barriers, this is a bit hard to do because typically we only have really good trade and goods tariffs. We don't really typically have good non-tariff barrier data. So what we're going to use for the services side are these services trade restrictiveness indices. It's actually not really in progress. We don't have the release from the ONS, but I can tell you what the answer looks like, which is that some of this kicks in, which is the goods tariffs are kicking in terms of that does have a negative impact on wages. It doesn't confound what we're finding. So you can put those things in and everything I'm telling you is still going to have very much even the same magnitude. So that's the sense in which, yes, those trade barriers are kicking in, but not in any kind of way that is a confounding factor. I'll show you another slide later. It's towards the end of after my talk. Okay, so then the other one that I think Mike was talking about a little bit, which is, it's not just that Brexit, the referendum happened and the only thing that changed was the exchange rate, people's expectations changed, so on and so forth. It turns out actually much of the uncertainty that people talk about with the Brexit stuff kicks in a lot later. That's what Nick Bloom and all find as well with the Bank of England survey. And we have a similar kind of survey that we can look at, which is from the Confederation of British Industry. I believe there is no such equivalent in the US, but if you wanted to give it a fancy name, I mean, it's like the Chamber of Commerce or some kind of loose association of all industries in the UK. And this is what you see. So this is them saying, are you less optimistic than 3 months ago? So the nice thing about the CBI survey is that it goes back a really long time. They've been consistently asking firms these questions. And we can cut the data based on who was more exposed, who was less exposed. And this is what you find. They're basically moving along together. There's, yes, a very sharp peak that happens here, but there isn't any kind of real systematic difference between what happened in the high intermediate import exposed industries versus the ones that were less exposed. So in that sense, again, it's not a confounding factor. Of course, that sort of thing is playing a role. We're also stopping it around here, which is 2018 Q2. We can extend it in principle. But at this point, there is some pickup in uncertainty that happened about the referendum because the Conservative government met, they had the Salzburg summit and things weren't going that well and so on and so forth. So some level of uncertainty kick happened there. And then finally, we can think about all sorts of other things like currency of invoicing, so on and so forth. I won't bore you since some of these questions didn't come up, but let me sort of move more directly to things that sort of try and conclude, which is just a minute away. So broadly, what I wanted to show you was that when the Brexit referendum happened, the first sort of almost immediate impact of that was this really unexpected depreciation of sterling, so one of the biggest depreciations ever in the world. And that then had an immediate impact in terms of what happened to prices that businesses faced. The cost shock from the intermediate import sides really kicked in. There wasn't an offsetting revenue effect. And as a result of that, what we see is that wages and training fell for workers that were in these exposed industries. And if you were to calibrate this to basically textbook theory, you would find that there is in fact production complementarity between workers and intermediate imports, a little bit different from what some of the papers find, which is emphasizing the sort of negative impacts on workers. This, of course, is a much broader set of workers. And if there's a particular number you can take back, that's basically saying a 1% increase in intermediate import prices lowers wages by somewhere between 0.2 to 0.4%. In fact, if anything, our numbers are slightly, maybe a little bit bigger now. So I'll stop here and leave you with the picture that I started with, which is to say, yes, originally these industries were growing together. And then there's this fanning out, which is much bigger than what you saw before. So that's the different diff with which I started.
Okay, great. So now we'll just leave the stream open for people to make comments or ask questions. If you have something, you can just jump in, or you can raise your hand if you like, and we can go that way as well.
Swati, I have a question, which is kind of, I kept having to remind myself that your paper really isn't about Brexit. It's just about using this exchange rate shock that was caused by it. But then it does mean, though, that it is a little bit like maybe what Mike Wall was saying, but it is a little different because it's associated with this vision of the future that's kind of muddied. And you mentioned that in terms of maybe that's why the exports weren't really going up much, because it's kind of like, oh yeah, we have this great period, and then it's going to be all hell's going to break loose once the actual Brexit occurs. So yes, that seemed like if you contrasted that with maybe a textbook case, which would be like some wacky central banker came in and just doubled the number of the currency of the UK, and that would also create a depreciation, but it wouldn't have created anything weird about looking into the future.
Yeah, so
it does seem like it kind of matters for the interpretation of these.
Yeah, no, it definitely matters for the interpretation, and which is why we're trying to do these cuts in terms of what the depreciation itself is picking up. So if you thought the depreciation itself was picking up some kind of economic linkages, then in principle, you would think of export shares, import shares, you would think of inward FDI, you would think of outward FDI with those countries. So we can do this at the country level, that how exposed is the UK to these different countries across the kinds of things that we think create economic linkages across countries. Doesn't really kick in any big way, except to some degree. And if you go further, then what you can try and think about is that, is it really sort of coming from the fact that this is to do with future trade barriers, this is to do with future FDI possibilities, so on and so forth. And this is what the next sort of graphs that I didn't, whatever tables that I didn't show earlier are. So this is now saying, okay, keep whatever I was showing you earlier, keep that intact, add to it different things which we think could be confounding, whether this is an exchange rate depreciation or whether you want to take a Brexit interpretation of it. How do you want to go with that? So this is now saying, okay, EU migrant shares we can look at. Kick in to some degree, but not in ways that's actually changing any of the main results that I was showing you. Then you can do more. I'm going to bore you a little bit, but I'll show you very quickly what those different cuts could be. These are trade barriers. So this is a little bit getting at what Dorian was also referring to. So again, keep everything that I showed you intact. That's the top stuff. Now start adding in tariff exposure across these different industries. You can think of, situations where there would be MFN tariffs that kicked in. You can think of situations where the UK services industries would start to face the same kinds of services trade barriers that the US faces with the EU, so on and so forth. We can keep sort of supplementing these things further and further and show you some of those cuts. Broadly, the conclusion I want you to take away is that those things, some of them will matter, but they're not changing this number at all very much. So I'm not trying to rule out that none of those cases are kicking in. In fact, I think the goods tariffs are kicking in, and this is the sort of result that earlier Dorian was referring to, that maybe the export side is kicking in because they expect to see trade barrier increases. But it just so happens that the same industries are also facing these, that it's not all because of the tariffs, it's really happening also because of the exchange rates.
Yeah, thanks.
Okay, there are more, we can do, but broadly, that's the picture we were trying to capture. So these are the FDI shares, which I think Daniel was at some point asking about.
I got to run in 3 minutes, but I'm still sort of confused as to how I would interpret that it matters more what is the composition of my imported intermediates than the amount of my imported intermediates. As I say, the depreciation of sterling against, the euro or the dollar is much bigger than this, 2% depreciation of the euro against the dollar associated with this thing. I just have a hard time, what is the model where this is the thing that's going to matter?
I'm totally happy with what you're thinking, which is that, look, what matters is that from the point of view of the UK firm, the dollar really tanks. And yes, the euro tanks as well, but, the pound tanks against the dollar, but less so against the euro. And you're saying that, look, that shock itself that happened, even with the euro, is actually quite big. So that is true.
It's much bigger than the move. It's a 2% depreciation. It's actually less than a 2% depreciation. It goes from 111 to 113, or the other way around. I don't remember. So the euro against the dollar, it's really not a big movement.
Yes. So if you go from the top to the bottom, this is like 11% versus 6%. So it's roughly like, you're almost doubling it when you're going from the bottom end to the top end for the countries that matter, the 23 countries that I showed you. That we have more countries in there as well. So that was actually the one amazing thing which happened with this referendum, which typically doesn't happen with any kind of just any exchange rate appreciation, is that even small trades moved, like even small currencies moved. So that's why we do have a lot of currency variation. In terms of sort of the other point which you're referring to, this is that, which is saying you can look at how much, roughly, I think this is what you were also asking about, but tell me if that's not where this is going. So this is saying, okay, how much do I actually import of stuff, so that any sort of, don't even worry about the cross-country variation, just tell me how much changed. So that's what would get picked up in these sorts of things here. And when we do that, those don't kick in. It seems like the cross-country variation really does kick in a much bigger way. And